Something big might be brewing behind the scenes, because the short sellers who thought they were in control may now be the ones completely trapped. In today's detailed market analysis, let's break down what's really happening with AMC, Wall Street's hidden pressure, and how new events including lawsuits, regulatory exemptions, and shifting institutional strategies might be shaping the next big move in this ongoing financial battle. This discussion is purely for educational and entertainment purposes, not financial advice. Welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads. Let's start with the main idea circulating across market discussions right now. Hedge funds are trapped in their short positions. A growing number of reports and community updates suggest that several institutions who shorted AMC heavily are now forced to hedge those positions using millions of AMC shares. This means they're stuck in trades that they can't easily exit without taking significant losses. A popular meme sums it up perfectly. You shorted AMC for a quick profit and ended up stuck for 5 years. That's the situation many funds now find themselves in, caught in positions that only get riskier the longer they hold them. We've already seen several financial institutions that had large short exposure face massive losses or even collapse, Credit Suisse being one well-known example. Now, let's talk about why this situation exists. In earlier discussions, we've seen that big players expected retail investors, the so-called apes, to eventually give up and sell, but retail holders didn't. While institutional traders can manipulate price movements by restricting buying access or pushing negative sentiment, they cannot force retail investors to sell. That resistance has created an environment where billions of synthetic shares circulate, making the situation increasingly difficult to manage for the short side. And here's where things get even more interesting. According to a tweet shared by financial analyst Trey, the SEC recently granted temporary exemptions that effectively help Wall Street. These exemptions delay enforcement of certain transparency and pricing rules until late 2026. This decision raises serious questions. If the market is stable, why delay regulations designed to promote fair pricing and reporting? We've seen similar delays before. Margin requirement changes have been postponed, short position reporting has been relaxed, and now other transparency measures are being pushed back. Each delay seems to suggest one thing: the current market structure is under strain, and institutions need time and regulatory relief to avoid triggering a bigger problem. If firms were meeting their margin requirements comfortably, there'd be no reason for exemptions. And if excessive short selling or synthetic activity weren't an issue, there'd be no reason to delay reporting. All of this suggests that the system is protecting the very institutions that may have overextended themselves while retail traders continue to hold. That brings us to the recent lawsuit filed by Genius Group, a company publicly fighting against naked short selling. Their case has drawn attention because it could set a precedent for other firms facing similar manipulation. In fact, just before their lawsuit gained momentum, several brokers, including Robinhood and Fidelity, temporarily disabled the buy button for Genius Group shares. This pattern echoes what AMC investors experienced in the past, where buying restrictions appeared right before major volatility events. If Genius Group succeeds in this lawsuit, it could expose widespread shorting practices and force a wave of position covering across multiple companies. This is why many retail investors see it as a potential turning point, not just for Genius Group, but for every company affected by excessive short selling. We've also seen other countries take firm action against these practices. South Korea, for example, recently cracked down on naked short selling, leading to stronger market confidence and bullish sentiment. If similar enforcement arrives in the U.S., it could dramatically change the landscape, possibly benefiting companies like AMC that have long been targets of short pressure. Now let's shift focus back to AMC's fundamentals. Despite constant negative sentiment, the data paints a different picture. According to analyst Steve's commentary, many assume AMC's share price will drop simply because of an authorized share increase, but this assumption overlooks a key point. Authorization does not mean issuance. The company can have authorization to issue more shares, but that doesn't mean they've released them into the market. Furthermore, AMC has been using strategic measures to manage debt, improve operations, and strengthen its position within an industry that's gradually becoming more resilient, even described as recession-proof. Analysts are forecasting positive earnings and cash flow growth in late 2025 and 2026, which could significantly alter the company's valuation outlook. Recent communications from AMC's management confirmed their expectation to remain free cash flow positive for the 9-month period ending soon. With box office revenue rising and major releases performing well, AMC's financial results are set to improve further into 2026. This aligns with projections that suggest a stronger overall movie industry and growing investor interest in the sector. When we compare AMC's balance sheet to competitors, the undervaluation becomes clearer. For example, according to a breakdown by Degen Life, AMC's debt sits around $3.45 billion with its stock price near $2.45. Cinemark has $1.87 billion in debt, but its stock trades around $29.69. IMAX carries $257 million in debt with a $34.84 share price. Paramount Skydance has $14 billion in debt, yet trades near $15 per share. This comparison highlights how AMC, despite significant improvement in managing debt and extending maturities, trades at a fraction of its peers' valuation. It's one of the few companies to convert a portion of debt into equity and extend repayment terms, reducing risk while improving flexibility. So the question arises, why does a company with a more balanced structure trade at the lowest valuation among its peers? Many analysts believe this disconnect comes from persistent short pressure and market sentiment rather than fundamentals. And that's where the story loops back to our starting point. The short sellers. According to a comment from Ignatius Van Zyl, with GameStop's turnaround nearly complete, the only way short sellers can now suppress prices is by continuously adding unreported naked shorts into circulation. But that's not sustainable. Every synthetic position they create eventually needs to be covered by purchasing the original shares, which pushes the price higher when the covering begins. Companies like GameStop can make this even more difficult for short sellers by declaring non-cash dividends, forcing shorts to pay additional costs to maintain their positions. This adds financial pressure to those holding synthetic or uncovered short positions and could eventually trigger another short squeeze. In simple terms, every delay, every exemption, and every regulatory loophole only buys time. It doesn't remove the underlying problem. The short positions still exist, and they're still growing riskier the longer the market resists manipulation. AMC, despite all the pressure, continues to improve operationally and gain long-term investor support. Institutions accumulating shares understand this difference. They see the low valuation, positive future earnings, and the potential shift in regulations as signs that the tide could eventually turn. At the end of the day, none of this is guaranteed, and as always, this video is not financial advice. But one thing seems clear. The situation for short sellers is tightening, regulations are shifting, and retail confidence remains strong. Whether or not this results in a future squeeze, the current landscape clearly shows that the imbalance between institutional manipulation and retail holding power is reaching a breaking point. What happens next may not just affect AMC, but the entire structure of how markets handle transparency and short selling going forward. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.